Hello, my name is Tianyu Yang, and I'm from the University of Michigan's Ross Business School, and I'm the Associate of Society of Actuaries. I've been trading stocks and options for years, especially since December of last year. I was pretty much exposed to all kinds of option strategies, especially since it has been a bullish market since the Christmas of last year. I mean, testing various kinds of option strategies to use in the bullish market, and currently I believe that one of the most reliable option strategies in the bullish market is called the put credit spread. And if you are unfamiliar with this concept, we'll introduce this later on. And the most profitable method of applying this method is to trade it weekly in the option expiration cycle. So it turned out that this is one of the best ways that you can make use of the probability. You can make use of the time decay and a lot of different benefits that you can secure a profit in your option trading, especially in a bullish market. So let's move on. So our goal is to win some have get some steady profit trading options. We are not trying to gamble. We are not just buying some really cheap out of the money options. Since even in a bullish market, only very few people can consistently make profit by just buying some out of the money cost, and you can definitely not count on this method to make consistent profit, since overall speaking, the probability is not you are not controlling the probability. The market is controlling it. And if you trade it for once or twice, you make a large amount of profit. But if you trade 10 times, 100 times, you will definitely lose a lot of money than what you can gain, since the law of large numbers. According to the law of large numbers, the more you trade, the more your winning rate of winning can steadily approximate to your expected probability. That is, if you are doing something that's really not very possible, then in the long run you will definitely lose more money than you can gain. And we have to believe that more than 90% of the amateur traders, retail traders, they are losing money every year trading options. They are that is. I'm not meaning that we can definitely make money by using this one or two strategies. We losing money trading options is not. You cannot prevent that from happening. But what we want to do is to make use of the best strategy and try to control our loss. So, what are some key elements that can lead to a consistently profitable trade? So, our goals. Firstly, we definitely want to something that have a high expected win rate and high expected return. We will definitely want our expected return to be greater than zero, since if you are purchasing out of the money call in maybe only with 20% or 10% probability that you will profit, but with a much greater probability that you will lose money. And also we expected this method to be traded for many times, since according to the law of large numbers, if you trade infinitely number of times, your probability of profiting it will approximate your expected win rate. And since we are doing something that is with at least 60 or 70% of profiting, so if we trade for a lot of times, we will approach our expected probability. That is, for example, if you are in the if you're in the casino, the casinos provide you with a lot of free drinks and free food and very cheap hotels. That's what, and they expect you to stay in the casino for many days. And yes, that so if you only play for one day or just play 10 rounds of game, you might be winning some money, but if you but if you play for about 1,000 rounds or even more, the it will definitely the casino will definitely be the winner, and you will definitely lose more and more money. Yeah, and we want our strategy to profit from the time decay, since we are holding it in the last week before expiration. So we would definitely want to profit from the time decay instead of holding calls and puts in the last week. That's definitely suicidal in terms of profiting. So yeah, and also because we always hold it in the last week, we are able to trade it for many times in a year, at least say 50 times in a year. And if you do that for 50 times in a year, and for each week you trade we say 5 or 3 stocks, then in a year, if the market has been bullish or even neutral in a year, then you can expect to make some significant profit from using a highly reliable method. And also, we would like to profit or at least remain unaffected from the decrease in volatility, since there are a lot of stocks that are currently not in its low range of the volatility, and if the volatility suddenly decreases, for example, if it keeps a more steady pace, or it just pass through earnings, and the volatility decreases, it can be very essential for the pricing of options. That's why we would like it to remain unaffected from the decrease in volatility. But since we are only holding it for a week, or we say 5 trading days, this might not be a big influence, but we would definitely want to prevent this from happening. And the next point is that we would like to avoid the naked position, since we are currently in a bullish market, and selling some naked puts, or not to say selling naked calls, is is not very worthy to do, since we need too much collateral as our margin. If we sell one naked put, we need 100 times the strike times of cash in terms of the margin. And if we sell naked call, we need 100 shares of stock to make sure that we are able to sell the stock or buy the stock back if the option exercises. Since if we place a naked sell order, we are imposing an obligation on us instead of keeping our rights. We definitely we must buy back our stock or sell our stock. So we would like to profit using relatively small positions in your portfolio. We don't want to take a large amount of money in your portfolio. And also another strategy we would like to do is that this strategy shall be beneficial for us on psychologically, comparing to doing just a call option. For example, on a strong day in the market, we would not want to close the position too early, just after the market opens, and we sell the position and we miss the majority of the profit. Since typically in a strong market day, it will not open with very with very high, with very maybe say as the market opens, the Nasdaq climbs for 1%. It might not likely happen, but it always keeps a steady climb to the maybe say 2 or 3% increase. So we would not want to close the position too early and miss the majority of the profit. And also, on a declining day in the market, we would like to control our loss, and we shall be easy to find a point so we can stop the loss. And also, since we don't want to spend too much time trading, monitoring the stock price and our underlying price, that's why we will not really want to use all of our money to buy calls and put options. We would like to, since we have our jobs, we have our other things to do during the time that the market is trading, and so we may just want to check the market for at least 1 or half an hour. So we need to have a method that we don't always have to monitor the stock price. And also we would like to have an easy option structure, so we are convenient. We are relatively easy to make adjustments. It might not contain too many legs, and maybe just 2 is fine. And lastly, we like to have less uncertainty about. We don't want to always consider about how to, which options I need to purchase to optimize our portfolio. Say which expiration date, which strike, and how to form this position. We would want to have relatively simple structure, and we want to have more less uncertainty. That is our goals. Now we introduce our option strategy called the bullish put spread or the bullish put credit spread. Since so the principle is that we buy a lower strike put, which is very out of the money, and we sell another out of the money put, but with a higher strike than the one we purchased, than the one we long. And so you can see the payoff diagram, kind of like a ladder. And since we are buying a cheaper put and selling a more expensive one, we are receiving a credit for this trade. So our maximum possible gain is that when the stock prices close beyond the higher strike, and both options expire worthless. If there are two, you see that we have a lower strike we purchased and a higher strike we sold, and so we are betting on the case that at expiration the stock prices close beyond higher strike, and the both put options expire to be worthless. And we would definitely want this to have a probability that is greater than 0.5. That is why we are doing this with a higher win rate. And what is our maximum loss? Our maximum loss is the difference in the strike, which is the strike difference times 100 and times the number of contracts you own. And you can easily see in your portfolio after you open such a position that how much money you've already gained or lost, and how much profit potential you still have in this trade. So let's move on to an example. Before the example, I would like to briefly discuss about what underlying stock we need to choose. Firstly, we need to do that with high liquidity. For example, say the daily volume of trading the stock to be greater than 1 million, and we need to have high option open interest. That's why the option and the stock both have high liquidity. By having the high liquidity, in the time we open such positions, we can try to avoid the effect of the bid-ask spread. So when the stock goes up by a little bit, we can purchase our lower strike put at a relatively lower price. And when the stock goes down for a little bit, we can sell our more expensive put. And by using this a little difference, we can almost erase our effect of the bid-ask spread. And that is based on the case that we are doing it in high liquidity and high option open interest stock. I suggest to choose from Nasdaq 100. Since we say the market is bullish, the Nasdaq 100 is very representative of the market. And these are all famous stocks. You have easy access to its news and to its to people's views about the stock, and to people's advice, and also is lots of people trade this stock. That's why it's more convenient for you to do it on options. You definitely not want to choose the stock that is very highly volatile, since you will have a higher risk. Please remember that you are doing the options then, and the options is based on volatility. So there's no, if the stock is more volatile or less volatile, it doesn't matter, since the options pricing is already considering the volatility. So even if it doesn't move for 1% or 2% for a long time, it's okay, since its volatility will be also very low, say about 11-12% or 15%. But as long as it begins to get more volatile, you will be gaining some money with options. And secondly, we would like to purchase options with purchase the stock with a longer option chain, so that we can have more choices. For example, Amazon stock is currently trading at more than $17,000, and it has option strike prices per $2.5. So we can see that it has hundreds of calls and put options we can choose, and so we can easily adjust our position. But for example, for AMD, it is currently about $26, and it has option chains every $0.5. That means we only have about 5 or 6 possible options to choose from. For others, it's either highly in the money or highly out of the money. It's not suitable for our trade. So if we say currently the AMD stock price is $26, the difference between the 27 strike call and the 26.5 strike call can be very different. It might be a 30% or 40% difference. So that makes it very difficult for us to adjust our position. So nextly, we would not like to trade through the major events like earnings and dividends. There's, I think, we all know. And for stocks in Nasdaq 100, there are some pairs that often show similar behavior, since they belong to the same industry. Say Nvidia, AMD, Micron Technology, and Western Digital. These stocks always show similar patterns and behavior, so we can just focus on one stock to save our effort, since it doesn't matter which stock you choose, but you are just doing the overall trend, and you are trying to win using the overall probability. Okay. So this is an example of Amazon stock in March 25th of 2019. So the closing price of this day is 17,76.89 dollars, and it is after the after hours trading. So after that it should be, so before that it should be $17,074, I think. So this is the position I opened during the trading. You see that I opened the trade approximately at this point. So you see that by the time the market closes, I already made a quite amount of profit. You see that I've already made $600 of profit, and this value of the position represents my remaining potential that I can gain from this position. Is about $1,400 left. So what does this mean? Since we see that I'm buying two puts at the strike price of 1,732.5, and we are selling two puts and 1,750 and 1,765. So this means that at the time the market closes on this Friday, the Friday of this week, which I believe is March the 29th. If the Amazon's closing price is higher than $1,765, I will be earning all of the rest money, which is $1,406, and this seems to be a pretty good deal. And the collateral I'm using is the strike difference times 100. You see that this minus this times 100, and this minus this times 100. So I'm the maximum risk I'm holding is $5,000, and this is based on the fact that I believe it's very unlikely for Amazon's stock price to close below $1,732.5 at the time the option expires on Friday. And in the actual case, I'm definitely not, if the stock keeps rising, I'm definitely not holding the stock till the expiration Friday. I either close the position and don't do anything else, or I move to a higher strike price, since if we say the stock price climbs to $1,800, I will have very few profiting potential, while I'm still occupying the $5,000 of collateral. So I don't think that's very worthy, and I can definitely use the money to do a lot of other things. Okay. So we can see the how this position profits. So we can see the from here you see the stock price trend for this day, and in the next page you can see the put options trend. You can see is approximately the inverse of the stock price, since this is still 5 days away from the expiration, and the time decay effect is not very significant. It is not until the Wednesday that you can really visualize the time decay in the put options price diagram. That is as even if the stock price stays the same, the option value keeps declining, and you can apparently see a downward slope in the option price, even if the stock stays where it is. And we can see the delta value, the previous closing and today's closing price, and the theta value of this stock. Since we see that this is the one we long, and those are the two ones we short, and the the two ones we short are closer to the current stock price. That's why it has more theta value. Please remember that the option with the most time value is the one that is closest to the stock price. And by either going up or going down, the time value decreases and the theta value also decreases. And from the delta, we can approximately see the probability that we can be successful on this trade. Since for the highest strike is $1,765, and the delta at market close is minus 0.41, approximately this value. That means we have about 0.6 probability that we can be successful on this rate, since this probability shows the probability that the option expires in the money, and we are betting on the fact that it expires out of the money. And we can see that from these numbers, the more expensive put options are apparently declining in value at a faster rate than the cheaper option. So we can tell that this is definitely a profitable thing to do if we are on the right track of the trend and we are entering in the right point. The next case is about where can we something else I need to mention is that this is a theoretical value given by the option spreading formula of this delta value. If the market is in an overall bullish trend, we definitely expect our winning probability to be greater than 0.6%, since the probability of the market goes up or stays the same is very high, and I'm not saying 1, but at least about 0.8%. And so this gives that our winning rate can be very high, and this can be a very secure benefit. And where can we stop loss or take profit? This is a very important topic of this trade. Firstly, I would like to say that we can exit the position and take profit only when we have at least pocketed 60% to 70% of the maximum possible gain. As long as this percent of profit is realized, since as we can see from here, by the time I open this position, the maximum profit I can realize is about this plus this, about $2,000. And I would like to say at least we paid a profit of $1,200 or $1,200 to $1,400 of the maximum possible gain, and we can consider exiting the trade to move on to a higher strike price, or just close and wait for the next week, or and it's based on the fact that you are very uncertain about the next day's trend. And if you are not, say in this case, we haven't made a satisfactory profit, we will try to hold it. We will try to hold it as far as possible, since our expected probability, say, no matter 60% or 80% of the winning probability, it works for the option held to the expiration. It's not a winning rate that will work for you today or just hold it to tomorrow. It is the probability that you can realize as only if you hold it to the option expires. And if you move to other higher strike and seek for more profit is your case, but your probability idea is that you want to hold it to the expiration. So the next point is that if you are trading with some small positions, you don't need to feel heartbreaking about if you are taking the maximum loss, since we already considered the fact that you might take the maximum loss in the expected return. So even if you take the maximum loss, it only accounts for the it accounts for a tail event, and you are not expecting it to happen a lot of times. If you trade enough, if you trade a lot of times, say 100 times, you will definitely cover through those loss by using by making the major gaining, by making the major profits from the other successful trades, since our expected value, our expected return can be greater than zero. And for a lot of cases, we are trading using a relatively large amount of money. So if the maximum loss is relatively large portion of your portfolio value, my suggestion is that you can stop loss when the stock price drops to the middle of the two strike prices. Where is this point? We can see the next slide. Okay, so we see that when the stock price is at this point between the two strike prices, that we are longing and shorting the put on. This is the last point where the time decay still works for our position, since we know that when the strike price is at the current stock price, it has the greatest amount of theta and the greatest amount of time value. And when the two strike prices are symmetric with the stock price, we have approximately the same time value. If a stock keeps moving down, then the time decay is harming our position, and I believe this is not a successful trade. We definitely want to stop loss and wait for the next opportunity. And my suggestion is that if a stock has a similar volatility and behavior with Nasdaq index, since the underlying asset I recommend is in the Nasdaq 100, there are a lot of stocks that behave similar to the Nasdaq index. We would want to this point to be at least 2% below the current stock price. That is the median of the K1 and K2 strike prices are at least 2% below the current stock prices. So by doing this value, we don't it's not very likely for the stock price to drop to this point during a regular day or week in a bullish market. So if the stock suddenly drops to these prices, there must be something serious that is happening to the market, and it is, I believe, it's often irreversible. That is, the stock price is very hard to bounce back from this point. Since if the stock market ended to be strong on this day, there might be at most a 1% or 1.2, 1.3% decline in the Nasdaq index, and it bounces back. If you see a more than 1.5 or even 2% decline in the Nasdaq index, there can be a very severe issue happening to the market, and you would definitely want to stop loss at this point. And you would need to have a sense of how much money you have lost if the stock price drops to this point. You can pre-calculate this value before you open this position. Please, we see that currently the Amazon stock price is about $1,775, and we are doing these two strikes using a $30 strike difference, since the one we are doing is, say, this one and this one is approximately $30 difference. So we can we can guess that if the stock falls to the middle of the strike price, the value of the two put options will be suddenly falls to this position. The value of the two put options will be close to these two values. So the $1,765 put will be similar to this value, and the $1,730 put will be similar to this value. So you can see the net credit of this position is about $1,500, and the value of your current difference, current two contracts difference, is about this one 17 minus 7 is about $10. So you expect to lose about $500 if the stock price suddenly drops to the middle of the two strike prices. Is this I believe this is a normal amount of risk you would like to undertake, since if it changes to this point, you will lose $500. This is relatively a good amount of loss compared to your profit potential. I believe this is a good point where you can stop loss. You can also have other stop loss in your mind, but the principle is that as long as you have it in your mind, you definitely want to execute it without any hesitation. If you hesitate and the stock price suddenly drops to even below the lower strike price, then you are losing considerable amount of money at a very fast rate, since all of your both of your put options become in the money, and they get closer and closer to the difference in the strike price. It can be very dangerous if this suddenly happens. And what I want to add is that the previous statements are based on the cases that you are quite uncertain about the market trend. If you are sure that the market will go down, say you see a negative news in the market, or you can see a clear trend in the market, say that the market opens very high and climbs a little bit, and then you see that the market forms a clear downward channel, then you definitely want to first exit the position and consider rebuild the position before the market closes, maybe half an hour before the market closes, since in such a market you expect the market to climb up a little bit before the market closes, since or then you definitely want to exit the position and reconstruct the position before the market closes, or wait for the next opportunity. This is all flexible. You definitely do this as flexible as trading stocks, since this framework just help us to get a better idea of how you can profit from making this trade, but not just giving you to doing something like a algorithm, or just you need to follow it strictly. This is a better idea, that this is an advantage that we can trade better than machines, than algorithmic trading programs, is that we can always adjust to the market based on our own experience and our own beliefs. The computer will still need a lot of deep learnings and a lot of neural networks to make a sense of the market in not very certain, but in quite a, to some probability they can make sense of the market. But if we are trading, then and we are very experienced, we can definitely make sense of the market. So the stop loss or the where we exit the position is all a rule of thumb. We must be very flexible, and we are definitely want to adjust to our principles. So we can see that by doing this strategy, we've satisfied all of our requirements. We have a high win rate, and we have a high expected return. For example, still using the case that we are doing a higher strike delta of minus 0.4, and we expect the stock to go up by a probability of 0.7 in a bullish market. Thus we make an interpolation to estimate the probability of making our max profit at expiration. This is the probability that both options expire out of the money. Is 1 minus 0.4 times this divided by this. It's about 76%. So it's a quite reliable idea, and even if this doesn't work, we have our stop loss in our mind, and we are definitely not taking our maximum loss. So this can be quite reliable. And secondly, we would like to make frequent trade using every week and using stocks that behave not exactly the same, but they might be correlated, but we don't want to choose stocks that behave exactly the same. So by making frequent trades and this is also this can not only benefit us from the aspect of law of large numbers, and by trading every week in the option expiration cycle, we can make use of the large time decay, and we can also have less uncertainty in the stock price, since if you compare the option price in the 1 week before expiration and 1 month before expiration, you can see that the option price 1 month before expiration is much less than 4 times the option price 1 week before expiration. That's because the theta is the greatest at the last week, especially in the last 3 days, and we definitely want to make use of this. And in the last week, we will have less uncertainty in the stock price. We will never know about where the market will move toward in the next month, but in the next week, the probability that the stock market suddenly makes a downturn or make a sharp turn to the other direction is very small, and then we are profiting from the time decay as long as the stock price is greater than the middle of the two strikes, and we are profiting from the decreasing volatility, since the one we are short, since the put, more expensive put we are shorting has greater amount of vega than comparing to the one we long, which is cheaper. By having more overall vega, we can profit from the by having negative overall vega, we can profit from the decreasing volatility, and then we can avoid closing the position too early and miss the majority of the profit. If the stock just keeps growing up, we will either move to the other higher strike price, or we just do nothing to our position. We would definitely want to close our position too early, as not as long as we haven't hit our profit target. We would definitely want to not want to sell our. We would definitely not want to close our position, and we can control loss on a declining day, since we can find a stop loss point, and we can easy to find a point where we can stop loss, and by the time the at the case the stock price suddenly declines, the time value will drop sharply. So the original stocks that you are shorting, the original put option that you are shorting, which is a more expensive one, will decrease in time value at a much higher rate than the one you long. So the difference in the decay of the time value can somehow control your loss if the stock suddenly declines. And then we will not have to monitor the stock price all the time, unless there are very big movements that can hurt our position. If we are longing a call option, we are having a highly nonlinear leverage comparing to the stock. So small changes to the stock can have a very major event to the call option, and the decay of the time value of the call option can make us very annoyed, and while not knowing what actions to take. So we would not need to monitor the stock price all the time. Even if the stock price stays at its original point, we are making our profit. We are making our maximum profit, which is not a small amount of value. Say we are making approximately $2,000 out of $5,000. It is a tremendous amount of profit, and we are doing this on a probability level of more than 70%. This is clearly a very reliable strategy to do. And the last thing is that it has an easy option structure. We can conveniently adjust to our position by moving the stock, moving our position up or down, or just closing it. We are easy to select which option to trade. We can just select the option that is expiring this Friday, and set the middle of the two strike price to be approximately 2% below the stock, or considering the stock's volatility, maybe 4%, 3% is based on the stock, and the difference in the strike price is just the maximum amount of risk you would like to undertake. So you can arbitrarily select by yourself. So lastly, I would like to say that we need to be careful of some things. Firstly, tail risk is always something that we would like to prevent as long as we are trading options, especially on the expiration Friday. If you already made the most profit, or you think that your risk, the difference in the strike is too large, you please definitely reduce the difference in the strike price, or close your position, or just buy close your position and buy a call option on Thursday. So since your maximum risk is always greater than your maximum reward, at the close after the market closes on Thursday, you already don't have much time value left, and you are just waiting for the option to expire. But consider the case that if at this time a sudden accident hit the stock market and the Nasdaq goes down by more than 2 or 3%, then your put options, both of your put options go high up to the sky. It can increase about 200 or 300%, and what you've gained all this week will quickly disappear, completely disappear in very short time, since the expiration Friday is very risky and very volatile. It is controlled by the forces that is quickly collapsing volatility and some other forces like the pinning effect. That is the option stop price goes close to the option strike price with the largest open interest. Although this is not proof or something, but you should acknowledge that the Friday is very volatile and highly risky. So definitely reduce your risk if you think you haven't made much of your profit or before Thursday market closes. So the next thing is that set a profit target for each week based on how much you want to risk. For example, say that I'm using $5,000 to trade options in my portfolio, and we can say that I want to gain $500 or $600 or $1,000 per week. This is given that we are in a bullish market, and we are confident that this bullish trend will still continue for several weeks, at least several weeks. So we can set a bigger profit target, say $1,000, and don't be greedy and always move to higher strike price that you made after you made enough profit. Please remember that at the time you initially construct your position, your expected probability it works only for holding the position till expiration. It does not work for renewing this position day after day after day. If the market has climbed for maybe say three consecutive days, are you still confident that the market can still climb? If you are not, then you definitely want to close your position, and you don't need to regret if the market still climbs on the other day, since your market you don't want to risk your maximum risk to in return for the remaining gain. Since if you have already hit your profit target, you can consider to wait for the next opportunity. And the third thing is that please trade using relatively small positions, unless you say you make more than $150,000 per year, and then you only have about $10,000 in your account. You don't quite care about your account's changes. But if you are trading to using your several years' salary, using your savings, then you must be cautious and you must trade using small positions. If you are trading using small positions, none of the failed trade can blow up your account value. And please remember that nobody can prevent a failure trade from happening, even if the most experienced people. You know that the James Cordier from optionsellers.com, he easily blow up all his hedge fund, although he's not hedging his fund and his customers' yearly savings by selling calls on the natural gas fund. It turns out that the natural gas fund climbs for 20%, and you see that climbing 20% for a natural gas fund can definitely represent maybe 1,000% increase in the options value. Thus, his account can easily be blown up by selling naked calls. And not to say this for such major event, by doing a failure trade using a great amount of position, it will greatly discourage you from making the right decisions, and it can also emotionally affect you from making the reasonable decisions. It will get you into worse and worse situation, unless you are just using your money to make studies of options. you just want to gain some experience. If you are a quantitative finance student, or you are a trader or professional trader, you're just trying to gain some experience. It is fine that you use large positions of your account value. But if you are trying to really gain money for your life, and this is a lot of a relatively large portion of your yearly income, then please be aware and trade using small positions. By trading using small positions, you are more likely to have steady gain. For example, if we are using the same strategy and we are trading using large positions, while we compare it to trading using small positions, we might eventually hit the same rate of return by using the same strategy. But if we trade using small positions, we definitely make more steady gain, and we are not very likely to be discouraged by some downturns in our diagram. But if we always trade using large positions on options, we can easily be discouraged by these events. And are we still able to make the right decisions and be fully courageous to trade on options? It might not be the real case. So if you are just please remember that try to trade using small amounts and using stocks that does not behave exactly the same as our underlying asset. And in this way, I believe it's quite possible for you to make steady gain using this put credit spread in a relatively bullish market. Thank you, and good luck on your tradings. Have a nice rest of your day. Thank you.